Good evening, Marshall Reddick clients. How are you? Welcome to tonight's presentation on private financing to help you build your rental portfolio. My pleasure to be with you tonight. My name's Patrick Prunty, and tonight's an interesting presentation. Although we've been doing private financing here at Marshall Reddick for quite some time, this is actually a new presentation we actually haven't done before. So bear with me. We've got a lot of good information. Quite sure you'll learn a lot as well, and super excited again to be with you. At the end, certainly answer as many questions as I possibly can. But again, we've got a jam-packed presentation. I'm going to try to get through it and keep it to less than 1 hour. So quickly, Marshall Reddick, been in business since 1979. And sorry about that. I think we had a little bit of a technical difficulty. Anyways, I'm back with you. Couple things about Marshall Reddick. First and foremost, been in business since 1979. We do brokerage locally here, Southern California, or in a number of investment markets around the country that we've hand selected. We work with, you know, the first-time home buyer, all the way to the expert who needs that private loan to buy the 11th, 12th, or even 50th investment property. We also do property management. And in addition to that, as we'll be talking about tonight, private financing. Specifically tonight, we are discussing from the borrower's perspective, but we do also lend private money. So any of those interested in going that route, it might be really good for you. The goals of tonight's program. Marshall Reddick Real Estate offers private financing. Hooray. Want to make sure that we get that in front of you guys and that everybody knows. We're going to compare conventional, which is commonly called conforming financing, with private financing. Additionally, when's the right time to use private financing? We're going to go over that. We're also going to talk about our loan programs and the details of those programs. And we're also going to talk about the ins and outs of how it works. So again, these are the goals of tonight's program. Okay, so first and foremost, some ground rules. Definitely non-owner occupied only. As far as it goes, residential real estate only as well, and no commercial property, unfortunately. We will still do some apartment buildings, so above 4 units, but those are on a special case scenario. Generally, it's going to be single-family homes or small multi-units like duplex and fourplex. The programs that we offer are good for purchase money, straight refinance, or also cash-out refinance. We also have a non-recourse option for the self-directed retirement borrower. Now, specifically wanted to talk a little bit about that. We got into this type of financing with a model around non-recourse, and I'll define that in a bit here. But you're only able to get the non-recourse option specifically if you are a self-directed retirement borrower, wherein it's required by the IRS. Now, we're not a bank. Okay, and I say that specifically because there are some banks who do play in the non-recourse space. North American Savings Bank is one of those, and simply from a rate perspective, oftentimes we cannot compete with them. And I've made a little joke here on the screen. I can't believe that they offer this type of thing, but I mean, a 1.16% annual percentage yield, that's how they're able to undercut the rate and offer non-recourse loans so inexpensively. They borrow the money at literally zero, and they lend it out for approximately 6% or so is the going rate. They are, however, very, very specific in what they will loan against and what they won't loan against. I'll say they're not that investor friendly. So Marshall Reddick has a special niche to fill the certain programs that they will not. So As far as non-recourse goes, specifically, this is a loan wherein the lender certainly can seize the collateral property. They can foreclose and take the property in the event of default, meaning the borrower does not make their monthly payment, but they cannot seek, that is, the lender cannot seek the assets of the borrower or any further compensation from the borrower should the collateral that they take back, the property, that is, not cover the full value of the outstanding loan. So there's always a lot of questions about that, but it doesn't bar the lender for foreclosing. It just, in essence, offers no personal guarantee as all conventional loans would require. So if you have questions about self-directing, I'm more than happy to help you. I have a self-directed IRA myself with the LLC checkbook control. However, I'm not 100% the expert. So if you have specific questions, I recommend speaking with Dmitry Fomachenko of Sense Financial. Dmitry is a close colleague of mine. He's the one who helped me set up my self-directed retirement account. Very, very knowledgeable, and he's always my go-to for any specific questions that I have. I'm sure he'd be happy to talk with you and address any specific questions that you might have. Let's take a pause there, make sure everyone is awake. Let's have a little poll and have some crowd interaction. So let's get this launched. Okay, so on the screen, you should see the question, do you have a self-directed retirement account? So I'm going to give you guys some time here, just a few seconds to answer the question. And then I'm going to publish the results so that everyone can see. Wow, some good responses here. Thank you. Just a couple more seconds. Okay, close the poll. So interesting results. Let's go ahead. You should see, okay, on the screen, with 70% of the vote in, 22% of the crowd tonight, which is extremely large, already have a self-directed retirement account. Good for you guys. And for the 41% who said, no, what's that? We'd love to help you. It's definitely an interesting way that you can invest in non-traditional assets like rental property. And for the 38%, feel free to give me a call or reach out to Dmitry. Wealth of information at your fingertips, free of charge, the consultation, of course, and glad to help you get started. All right, so let's dive in a little bit. A lot of common information here, but not so common to everyone. So conventional versus private financing. The bottom line here is that Fannie Mae and Freddie Mac, a couple of quasi-government agencies, they really set the tone for the conventional lenders. And the reason that is because all the conventional lenders in the country, they subscribe to the guidelines provided by Fannie and Freddie. And they do that because those lenders originate the loan, but then almost immediately they look and turn to sell that loan in the secondary market to none other than Fannie and Freddie. So if they do not subscribe to those guidelines, then Fannie and Freddie will not buy them, right? So it's not necessarily the lender that doesn't want to make the loan, it's Fannie or Freddie that doesn't want to buy the loan. And that's why they're so important to the real estate market and to the lending industry. Private lenders like myself, we have no intention of selling our loans that we originate to Fannie or Freddie, so we don't have to conform to their guidelines, plain and simple. In either case, private or conventional, the lender is primarily concerned with risk. The question overriding always is, if I make this loan, will I get my principal and my interest back? So conventional lenders and private lenders look at answering that question very differently, and we're going to dive into that. So as far as conventional financing goes, as you guys all know, it's really overwhelming, especially for investors like us who have many mortgages already, who have very, very difficult and in-depth 1040 tax returns, perhaps small businesses and things of that nature. We may not fit into the cookie cutter model that the lender wants to see. because of that, you might need to go private. But I have a lot of information on the screen here just to kind of show you how difficult it actually is. Nonetheless, a couple of things. Deal breakers, bullet point number 2 there. You know, if you've got a short sale or a foreclosure or a bankruptcy, it's a lot of time before a conventional lender will even look at you. Another reason, number of financed properties. Fannie Mae's got a guideline that after 10 properties, they don't want to buy the paper from the borrower who has an 11th, 12th, 13th, or so on private loan, mortgage property. So with that in mind, those types of investors like myself and a lot of you I see on the call tonight have to go private at that time. But conventionally speaking, the lender requires all of these items in order to reduce their risk, right? To ensure that they're going to get that principal and interest back, right? And because of that, being a lot more invasive and getting a lot more information, that in turn gets the borrower here in bullet point 3, the lowest down payment, so 20 to 25% today for investor, and lowest interest rates, which today are hovering between 4 3/4 and 5 1/4. Right? Again, I'm comparing investors to investors because we, again, do not do any owner-occupied lending. So always, if you can, go conventional, right? When you're buying rental property, you want to make the numbers work the best to your advantage. So certainly don't just go private because it's easier. Only go private when it's necessary. So private financing, the focus is almost entirely on the property, as opposed to with conventional, it's almost entirely on the borrower, okay? So for us and for other private lenders that are out there, we're really concerned with the equity position of the borrower. We're also highly concerned with the cash flow of the property, as well as the value of the property. Okay, so we're not concerned with credit score, employment, citizenship, and there's no personal guarantee. I mean, at the end of the day, our private loan programs we're going to get into here are really revolve around the non-recourse model, where a large down payment is going to be needed because in a non-recourse sense, there is no credit score. There is no employment history because you can't go after the borrower because the borrower is an IRA or self-directed retirement account. So even though not all of our private loans are non-recourse, we adopt that same model. So we really don't care about credit score, employment. We're answering our question, our risk question of reducing our risk and am I going to get that principal plus interest back? And we're confident of that with 2 factors. Number 1, the down payment, and number 2, the cash flow of the property. Now, there are still some deal breakers for us. The borrower has to have reserves, and I'm going to get into that a little bit, but it's 6 months minimum, 6 months principal, interest, taxes, and insurance minimum, or $3,500, whichever is greater. So, additionally, you have to have United States tax identification. We do have quite a few foreign borrowers, and that's okay. But you do still have to have a United States tax identification number. The loan servicer will require that. We also have a threshold at loan amounts of $25,000. A conventional lender, their threshold is commonly going to be $50,000. So we play in that special niche market there between 25 and 50. But we certainly do make loan amounts higher than 50, much higher in fact. In any case, our risk is a little greater and we're a lot less invasive in what we require in terms of loan approval. So that translates into a borrower higher down payments and higher interest rate to offset that risk for the lender. Okay, so when is private financing appropriate? Well, I mean, the bottom line simply is when the conventional lender can't help you, right? There's many reasons why they can't, and I'm sure we've all heard them, right? Those of us who are sick of hearing, you have too many financed properties. That's me personally. I mean, I'm building a portfolio. I'm going to be getting close to 15 here, pretty close. And there's still many good deals out there. I just have to go with private loans because I still want to use leverage as opposed to paying cash. Your debt to income ratio is too high. You've got a short sale years ago. I mean, considering the recession we came out of 7 or 8 years ago, who doesn't have a short sale or foreclosure? How many times have you called or asked the bank and asked them about a non-recourse loan and they're like, huh, what's that? I mean, the list goes on. We've all heard it. So Marshall Reddick offers programs for the following. Number one, buy and hold, right? These are long-term loans, commonly used for purchase of turnkey property. It doesn't necessarily have to be quote unquote turnkey, but rent ready, right? And these have terms of 5 to 30 years. So these rival what a conventional loan would look like. We also have programs for fix and flip or fix and refi. So this is common today. You know, most of the people that are doing this are borrowing to buy distressed property, foreclosure, short sale, you name it, or property that's just in disrepair, right? And you can't get a conventional loan against it, no matter how good your credit is, no how much cash you have in the bank, etc. Now, again, these are short-term loans, 12-month max, right? You don't have to hold it for 12 months, but that's going to be the maximum period of time that you can hold it. Now, I've got an asterisk on the screen because that fix and refi, also known as BRRR, or buy, rehab, rent, refi, and repeat, for all of those bigger pockets folks out there. Seems to be a trend that's going on, and it's not a bad idea, but it's not easy either. But nonetheless, we do offer these two different types of programs. So diving into the long term, my rate sheet is on the screen. So we offer 4 loan programs, and I wanted to point out specifically the 30-year fixed. This is a program that is not offered anywhere in the market. I have not found another lender that offers a 30-year fixed, fully amortized loan. Okay. Again, my rates are going to be higher than a bank's would be, at least a bank that would make a non-recourse loan, such as North American Savings Bank. But my rates are palatable and they do work well in certain instances. Also wanted to point out that the payment column on the screen here, and I'm going to use my highlighter to show that. So this payment here is going to be based on a $100,000 loan amount. Okay, so in this $100,000 loan on a 30-year fixed at 8.5%, is going to carry roughly an APR of 8.9%, and you're going to have a monthly principal and interest payment that won't change of $768.91. Okay, additionally, I wanted to point out that all of our long-term loans have a 3-year interest guarantee. You can call that a prepayment penalty if you'd like, but as long as you don't plan to hold the loan for less than 3 years, then you won't have any effect on you. And for those that aren't quite sure what that means, I'll dive into that in a second. So to summarize our loan programs for buy and hold, it's 60% maximum loan to value. Right? So that's our big down payment. We're going to require 40% down minimum or 40% equity position for those refi or cash out refinance borrowers, right? We have to have strong cash flow, meaning that your maximum monthly PITI payment can be no more than 75% of market rent. Now I've got a quick little formula on the screen there. And if you market rent is $1,000, your maximum monthly PITI can be no more than $750. Okay, and again, PITI is principal, interest, taxes, and insurance. And so basically what we're doing, for those of you who know us here at Marshall Reddick, we know that maintenance and vacancy happens when owning rental property. So in this case, we're forcing you to reserve 25% of that rent to go towards those maintenance and vacancy costs that will happen. Again, that 30-year fixed option is not offered elsewhere, and it's highly desirable to a lot of folks looking to build that large rental property portfolio. No programs that we offer in the long term are interest only. So sorry, that's not an option. They're all amortized, either 15 or 30 years. We do have that minimum loan amount at $25,000, and a lot of times, not always, but a lot of times, loan amounts between 25 and 50 will require an additional monthly fee. That's the loan servicing fee to be paid by the borrower. And the bottom line, the reason for that is, as you'll find, our lenders are Marshall Reddick clients, just like you. And that $20 or $15 per month loan servicing fee drastically cuts into a, say, $35,000 loan where your monthly payment's about $175 per month. So just a little point to note. Again, these programs are available for purchase, refi, or cash out. And again, we have the niche program here. A lot of business is coming from the non-recourse cash out refinance. Okay, so North American Savings Bank will allow a refinance, but they're going to cap your loan amount at 70% of your original purchase price. Now that can be huge considering the recession we came out of, where a lot of you were super smart and bought property distressed at well under market value. Right? It's gone up today to what market value should be, and you'd like to borrow against what market value is to get your original capital back. North American Savings Bank will prohibit you or limit you there, where we will not. Again, I mentioned that 3-year interest guarantee. So let's have a little example about how that actually looks. So on the screen now, I've got just a regular amortization table based on the 30-year fixed at 8.5%. Okay, so the 3-year interest guarantee will be set based on the terms of the loan prior to funding. In this case, where I've got a loan amount of $41,700, it translates into, at 8.5%, a monthly payment of $320.64, and then an interest guarantee of $10.5. And that interest guarantee is simply the cumulative amount of interest paid over the first 36 months of the loan. Okay, so certainly as the borrower, you're more than welcome to pay off the loan inside of 36 months. But for example, if you do that, say here at month 23, you've only paid a little under $7,000 in cumulative interest. So if you decide to pay it off at that time, you're going to owe the lender the difference between the $10.5 minimum interest guarantee and the roughly $6,700 you've already paid. Okay. After you pass the cumulative interest guarantee, there is no penalty to pay off the loan. Feel free to pay it off at any time. Okay. We do require reserves, as I mentioned, 6 months of principal, interest, tax, insurance, or $3,500 minimum in the event your 6 months payments are less than 35. We do not impound or offer escrow account. So you as the borrower will be required to pay the taxes and the insurance and or any homeowners association directly. We offer straightforward loan pricing. Okay, a lot of lenders that are out there, I won't name any names, have a lot of junk fees, right? $695 processing, $895 underwriting fee, etc. Right? They bait you with the 1% loan fee. Instead, we use straight up. 3% of the loan amount will be your loan fee to Marshall Reddick as the lender, minimum $1,000. There's also a $275 doc prep fee, which just covers the cost of the attorney's doc preparation. Of course, we're going to check to make sure you're not in a flood zone. That's a $10 cost. Again, a pass-through cost not collected by Marshall Reddick. And then a $115 tax service fee, which is pretty standard. And that's just going to be paid to another third party who's going to make sure that you're paying your property taxes every year. There, of course, are third-party closing costs. We use a third-party appraisal management company, so we have no control over the appraisal, but generally I'm seeing those appraisal costs between $450 and $550. Escrow, title, and recording, those other third-party costs, they all vary by the escrow firm and the geographic location. We're happy to estimate those for you on a case-by-case basis. As far as closing goes, we're pretty quick, right alongside the bank or any other private lender, and definitely can get it done in 35. And commonly the closing happens sometime between 30 and 45 days. However, note that the speed of closing is based largely on you, the borrower, or your custodian, who effectively is the borrower when you're a self-directed IRA. It also has a lot to do with the appraiser. In some jurisdictions, that appraiser can take up to 3 weeks or more. It's not going to be Marshall Reddick's problem, or Marshall Reddick will not be the problem that your loan is not getting funded inside of 30 days. Also, just a tidbit about loan servicing. We use Superior Loan Servicing or the Note Servicing Center, both who are located here in California, but can service all of the jurisdictions where we loan. Okay, again, programs and rates that we offer here at Marshall Reddick. As a quick refresher, as I dive into an example pro forma of what it would look like for you buying a rental property from us with private financing provided by us. Okay, so here's a cute little rental property, Oak Grove, Kentucky. It's about 45 minutes northwest of Nashville, a very booming area. I won't spend too much time on this. Those veterans here certainly understand how this works, but based on your purchase price at $69,500 and understanding that we are doing a 30-year fixed mortgage at 8.5%, your monthly payment is going to be $320.64. This is the exact same setup as the amortization table I showed a few slides previous. So add up all your monthly recurring expenses, and you're looking at monthly income in this situation of just a little over $3.25. That's huge. Okay. Of course, putting aside for a rainy day, your maintenance and your vacancy, along with your leasing factor, you're looking at true cash flow of $131 a month. Again, folks, this is with a private loan and 8.5%. So certainly you do have a larger down payment, but don't go private if you don't have to. Buy this conventionally. But if you still looking to build that rental portfolio and you can't qualify conventionally, we can help you get it done with a private loan. Okay, that same exact example, folks. Same property, same terms, except we're looking at a little bit different loan amount. In this case, we're going with the 10-year balloon option, which carries a little bit lower interest rate. You still get that 30-year amortization, but you get a little cut rate from 8.5% to 7.5%. But remember, at the 10-year mark, you're going to have a balloon payment wherein you'll need to pay off the remaining principal balance at that time. Okay, so you get a slightly lower mortgage payment there, which translates into a little bit more monthly income, which translates into a little bit higher legitimate cash flow. Now, what was the difference though? I think it's about $30 a month. And for all the borrowers that I talk to, certainly that $30 a month adds up over time. But at the end of the day, I'm a buy and hold investor. I never go into any loan thinking that I'm going to pay it off inside of 10 years. So I'm more comfortable with the peace of mind knowing that I don't have that balloon payment at the 10-year mark. Now, the sophisticated investor, if you know what you're doing, all good. But at the end of the day, that $30 extra and that 1% extra, it might not be worth it, again, for that peace of mind to know that you don't have to do something if you don't want to at any time throughout that 30-year loan. All right, so let's dive a little bit into our short-term programs. A lot of people have been calling, a lot of interest here. So again, diving into our short-term, again, fix and flip or fix and refi for those sophisticated investors. The top two terms, those are going to have a cap, folks, at your purchase or at your cost. So when you're buying that foreclosure, we're not going to lend more than 100% in the first two programs, which will get you 9 or 10% interest rate. That 9% program is going to require monthly interest payments. The 10%, I can get you a balloon. Again, but the cap on that 70% ARV is going to be at your cost. Whereas in the 12% option, we're willing to go as high as the 70%, even if it's more than 100% of your purchase, which can provide you some capital towards your renovation that's necessary. In this one, obviously it's a shorter term loan, but there is still an interest guarantee. It's a 3-month interest guarantee in this case. Again, not generally a problem. Nobody gets the property acquired, fixed up, and refinanced or sold inside of 90 days. So this will have no effect on you so long as you hold the loan for longer than 90 days. So let's summarize these. Again, 70% max loan to value, and that's going to be based on after renovation value. A lot of questions I get on that. Who's the decider of the after renovation value? The Marshall Reddick underwriting team will decide what the comfortable after renovation value is. We'll certainly take input from you, the borrower, but we won't be swayed by that input. There is no appraisal, right? It's called a desktop underwriting or drive-by appraisal, if you will. Maximum 12-month term, again, balloon option available. In order to obtain one of these loans from us, you're absolutely going to have a crystal clear exit strategy. Minimum loan amount here is going to jump up a little bit. It'll be $30,000. And again, that 3-month interest guarantee. There is a non-recourse option available. However, it's not likely, right? A lot of people call about it, but we really can't fit most folks into the parameter, but we will entertain a short-term fix and flip or fix and refi non-recourse loan. Please, however, no weekend warriors or HGTV junkies. Flipping property is very, very hard, folks. Everyone's got to start somewhere, but I'm not sure we're going to be willing to make a loan for one of those first timers. Okay. Jumping to number 5, however, if you do know somebody who is experienced, knows what they're doing, got a lot of deals under their belt, ask about our referral program. Happy to offer some remuneration for an introduction. So pricing, again, straightforward, a little bit less than the long-term loan. That's a 2% loan fee. Again, the $275 doc prep fee, but again, no junk fees outside of these fees. Closing's very, very fast. We understand that in a distressed situation where your seller needs to unload quickly and needs that cash right away, we can get it done in 10 days. Sometimes we can get it done less than that. But understand, a lot of times you're not going to be waiting on Marshall Reddick. You're going to be waiting on escrow, perhaps your insurance, perhaps you. But at the end of the day, again, it's not going to be Marshall Reddick. In this situation, in the short term, there is no loan servicer, but Marshall Reddick will function as that point of contact for the borrower and function in a capacity similar to the loan servicer. So let's dive into a case study here. I'm a numbers guy, so I absolutely love this. And I've got my staff here looking into this and like special VIP clients who are really, really interested in doing stuff like this. It is possible. We'd love to help you. Okay, so here is the example. Another cute little home in Oak Grove, Kentucky. And if you were to buy this just straight up, you know, as a turnkey property or as a rent-ready property, you'd be buying it, or its after renovation value is about $85,000. Okay, so you'd be looking at a down payment of approximately $20,000 to obtain these numbers. All right. So instead, how cool would it be if instead of going out, your all-in total investment was only $2,680. Let me show you how you can do it. Okay, it's a little difficult, but it can be done. So in this situation, this is a 3-bed, 2-bath, 1997. It was a VA foreclosure, right? The purchase price or the winning bid was $36 grand. Okay, so let's dive into the numbers. Again, that after renovation value and that anticipated appraisal after fix-ups, about $85,000. Okay, based on that number, Marshall Reddick's willing to offer a short-term loan at 70% of after renovation value, which translates into a total loan amount of $59,500. You buy that property for $36,000, you got to pay the wholesaler. That's a $10,000 cost. Your closing costs, your loan cost, and your all-in renovation budget, $15,000. Okay, so your all-in total, $63,460. But again, Marshall Reddick's coming in with that $59,500 loan amount to help you make your purchase and cover your closing costs and renovation. In this case, your total out-of-pocket to make the acquisition and get the property fixed up, it's only a little shy, hair under $4,000 bucks. Now, once you get to this point, you've got it acquired, you've got it renovated. Fast forward 6 months down the line, you go to conventionally refinance that property, cash out, right? How do you do it? Well, again, we're basing that conventional refinance 80% of appraisal, what we can get done with a conventional lender. So then based on an anticipated appraisal of $85,000, you're going to be looking at a loan amount of $68,000. Okay. Of course, you're going to have to pay off that short-term loan, and you're going to have some closing costs. But first, the closing costs for that refinance loan, about $3,500, right? So take that away from your loan proceeds, you're going to actually end up with $64,500 towards the payoff of that private loan you borrowed to make the acquisition. Okay, so pay off your loan, which was $59,500 plus interest, translates into $63,200. Okay, so you pay off that loan with the proceeds, the $64,500, and guess what? The lender gives you a check back at closing for $1,280. Okay, remember you were in it for $39.60. So guess what? You're all in total $2,680. Now, not a program for everybody, right? It sounds sexy. It's super difficult, maybe not the right for the full-time attorney or someone who doesn't have the time to spend to make this all happen. But for those specific people who can get it done, we can help you. We're glad to do that. Okay, how the nuts and bolts of how the Marshall Reddick private financing programs work. All right, number one question, how do I qualify? Okay, bottom line, you fill out my loan application and you show me proof of funds. You show me your tax identification and we run an analysis on the property's cash flow. Now, if you don't have a property already identified, no problem. We'll talk in generalities, right? But if you provide these items, we can easily get you qualified, right? There is no credit check. There is no employment verification. There is no debt to income ratio analysis. None of those other things that you're going to get with a conventional lender. It's quick, it's down and dirty, okay? So what's the loan application look like, right? This is my asset-based loan application, not non-recourse. But maybe you're a non-recourse IRA or solo 401k borrower. If you are, great. We'll just give you our non-recourse loan application. So it'll just depend on your situation. Nonetheless, super quick, should take you all of about 5 or 10 minutes to complete and get back to me. Now, moving along, who actually lends the money, the private money we're talking about, to help you with your purchase or refi? Well, it's actually other Marshall Reddick clients like you. And probably I've got some folks on the call tonight who are some of my private lenders, right? I have a lengthy list of investors who prefer to bank and lend and collect the monthly interest check, right? As opposed to what most of us are on the call for tonight, which is to buy and own the property and collect the monthly rent check. So maybe there's some of you out here who didn't think that was a possibility. And if you're interested in lending money, certainly can help you with that as well. So let's talk about the Marshall Reddick website. Very, very cool, dynamic. It's changing all the time. So stay connected and stay close, okay? First and foremost, let's talk a little bit about the Invest tab, right? You've got, hover over the Invest tab on the homepage and you're going to get a dropout that's properties and mortgages. For those of you interested in actually buying a property and using private financing, check out our calculator. It's absolutely amazing. For those of you interested in more about the private lending I was just talking about, check the mortgage tab, right? That's where all of our mortgage investments are going to be, right? And that's where you, if you go through the private loan for us, that's where you're going to find your private mortgage available for funding from another Marshall Reddick client, okay? So I did want to dive in quickly and show you actually on the website. So hover over that Invest tab, like I said, dive into the properties. And let's take a look at this particular property. All you got to do is click on any property on the website, right? You're going to be able to look and see photos of the property, right? You're going to be able to see a lot of information about the schools, about the market history, average annual appreciation, right? We do a lot of education. But what I really wanted to point out here was this financial summary, right? So it defaults to conventional financing here, right? But you could also toggle and look at a cash purchase, or you could look at private financing, right? Which is super cool because all of us that are out there looking at private financing. So in this case, if I want to click private financing, it drops out all of my private loan options, right? And then below that's my calculator, my dynamic calculator to actually run my numbers. So maybe I'm interested in the 15-year fixed. Click that, see it's highlighted. Now it's going to give me my mortgage payment and everything based on that in the terms of this property, right? Again, you can change all of this information. Or maybe I'm interested in the 8.5% 30-year fixed. All you got to do is click and let the numbers run for you. Super cool. Definitely spend some time on the website and reach out to one of our real estate advisors. They can certainly help you navigate the waters. Back to the presentation. Here's the web addresses. Invest in properties, invest in mortgages. Also coming soon, very, very cool. You're going to find this borrow tab, right? It's going to make it very easy. The loan application is going to be online. It's just changing constantly. I can't tell you guys how excited we are about the website to bring to you guys. That's going to be at marshallreddick.com/borrow in the very near future. Okay, let's run through our process flow. I definitely have a couple of questions that I wanted to get to, and definitely want to keep it under an hour. So the process flow for our private financing. Okay, so number one, application. Collect that from you along with your documentation. If you're an entity like an LLC or a corporation or a trust or something, that's the type of documentation I'm referring to. Of course, proof of funds, right? We're going to need to see that you've got the down payment, the closing costs, and the reserves, right? Once I have that first bit of information, I'm able to provide you that all-important pre-approval letter, right? This may not be important in a turnkey purchase situation, but for those of you out there buying just MLS stuff or off market, right, you need that pre-approval letter. I'm happy to provide one customized for you so that you can let your seller and your seller's agent know that you're a serious and qualified borrower. Once you've got that, then of course you're going to move into the pre-approval, into the making offers and the contract process. Get that contract accepted and get it back to me so we can get this show on the road. Our next is going to be, we're going to dive into escrow, where you'll be putting your earnest money. You're going to get your inspection, title work, and of course, we're going to order that appraisal. All right, with the satisfactory appraisal and clear title, we're going to be moving along right into loan documentation. Very, very similar to what you'd find with a conventional lender, except it's about a fraction, maybe 1/50th of the size of a conventional lender's loan package, right? Our private loans are not subject to RESPA and a lot of the regulation that's out there that revolves around owner-occupied lending and conventional Fannie Freddie lending. Right, so, but we do use the standard Fannie Mae trust deed and mortgage, promissory note, etc. You'll also at this time be getting your homeowner's insurance, and absolutely 100% we do require you to carry insurance on the property, just like the bank would. Okay. Last step, closing funding and loan servicing. Hooray, right? We've gotten to the end, right? You picked up that next rental property. Congratulations. So a little bit more about loan servicing. This is simply a third party hired by the lender, and it handles all the correspondence with you, the borrower, right? And you as the borrower, you really want that loan servicer to be there, right? You don't want to talk to the lender, and the lender, frankly, they don't want to talk to you. It's kind of like you as the borrower, and you don't really want to talk to your tenant, right? The tenant doesn't really want to talk to you necessarily, right? So you hire that property manager. So the loan servicer is like a property manager for your loan. What do? Well, it's just a business that's in the business of collecting monthly payments, remitting them to the lender. They are able to answer any borrower question that you have. They handle all the year-end paperwork, the 1098 and the 1099. They do all of the accounting. So if you ever want to pay off or to understand, what your principal balance is today, you just call or email the loan servicer, or you log into their fancy website and see all that information online. Let's jump in with another poll. Make sure everyone's still awake out there. So poll number 2, let's get it launched. So how likely are you to utilize private financing in the next 12 months? Okay, so I'd appreciate it if you could dive in and give me your thoughts. Thanks so much for getting some good response here. Appreciate it. Give a couple more seconds here and we'll wrap it up. Couple more seconds here. Okay, we will close the poll. All right, so let's share the results. Awesome, again, love these poll results. Again, with just about 70% of the crowd chiming in, gosh, 16% of you looking right now, shopping lenders. I'd love to talk to you. Talk to you about who else is out there. We're very transparent. If we're not the right lender, no problem. But for the lion's share, looking that it's definitely a possibility for you, you need more information. Great, no problem. Happy to talk to you as well. Hey, and great. Looks like I've got just a little bit over a quarter of you interested in becoming one of my private lenders. It's a good gig. It's totally passive. You might really like it. So I look forward to speaking with you as well. Okay, so I think we'll wrap it up there. Actually take a couple of questions. But again, my name's Patrick Prunty. It's my pleasure speaking with you tonight. My contact information's on the screen. Love to chat with you. Happy to answer your questions through email as well. But let's see if we can't get a couple of questions from the crowd. Okay, so first question. Can I get a better rate or different loan program if I put more down? Great question. Unfortunately, however, the answer is no. Our loan programs are set. You're certainly welcome to put more down than the 40%. You don't have to borrow the max, but the loan programs are not negotiable. Okay, so again, good question, but the loan programs are what they are. We've set them palatable for the borrower, palatable for the lender, and they really make a lot of sense on both ends. Got another question here coming in. It's excellent. I think I covered this, but perhaps not. Am I required to obtain title insurance for my purchase or my refi? And again, the answer to that is absolutely. On the purchase, you're definitely going to always want to have title insurance, right? And from the lender's perspective, they absolutely need a loan policy, and they need to make sure that you're getting clear title to the property. In terms of a refi, a owner's policy might not necessarily be needed, but certainly a lender's policy would be needed, and that would be a cost that would be borne by the borrower, not the lender. Another question, I think this will be the last one because I'd love to wrap it up and let you guys all get on with your evening. Question being, again, for both short and long term, what are the minimum loan amounts? So in the long term buy and hold, okay, the minimum loan amount is going to be $25,000. But again, think about that. You don't really want to get below that. I mean, we're talking about 60% loan to value. You'd be looking at property under $50,000. You know, properties that start to dip under the $40,000 mark, probably not in the best neighborhoods, and unless you're a super sophisticated investor, probably not the best investment. Okay. As far as the short-term fix and flip loans go, again at 70% loan to value, our minimum is going to be $30,000. Okay. And any properties that you're going to be buying, distressed or not, that are under $30,000, again, same kind of dynamic. Probably not going to be the best long-term rentals when you refi to hold. So again, thank you guys so much. Appreciate y'all bearing with me. I know we had a couple of technical difficulties in first run through of this presentation, but appreciate you all and look forward to speaking with you very soon. Have a great night.